So multifamily syndication, right, or the process where investors essentially pool their money together to go buy a larger commercial building, like a large apartment building, can be a complex process and it can have a complex structure, right? There's usually different parties involved. Each party has different roles, responsibilities, different financial responsibilities as well. So what I thought I would do in this video is talk about the parties and the structure involved when a multifamily syndication comes together, talk about the roles, responsibilities, as well as the financial responsibilities and how each party gets paid. So whether you're an active investor or passive investor, you'll have a great sense of exactly what goes into the syndication. But before we get into that, really quickly guys, my name is Lior and I am a multifamily investor here in Boston, Massachusetts. I'm an investor and syndicator, and really quickly, if you have not subscribed to my channel guys, make sure you smash that subscribe button for me. I'm putting out daily content on this channel talking everything about multifamily investing, syndication, running a business in the space, tips, strategies, wealth building tactics, and literally everything in between. So if that's the kind of content you're looking for, make sure you subscribe to the channel. So let's get right into it and talk about the structure and the parties involved in a typical multifamily syndication. So really simply, you typically have two parties. You're gonna have your GP or the general partner, which is also called a syndicator or deal sponsor, right? There's a lot of terms for it. And then you're gonna have your LP, right? Your limited partner, your capital partner, your equity partner, right? There's, again, a ton of different ways to phrase it. Now, those are your two main parties, and typically what they do is they split the ownership of the total LLC that's going to go by the piece of property of interest, right? And that percentage split, right, like how much does the GP own versus how much does the LP own, is very much deal dependent and depends on the numbers, the metrics, the deal sponsor himself or herself, right? But typically what we see in the space is usually limited partners will own anything from 60 to 80% or so, whereas the general partnership will own anywhere from 20 to 40%. Again, depending on the deal. Now let's talk a little bit about each party and what they're responsible for, right? So the general partnership, right, or the GP, is essentially the operating partner of the deal. And they're literally responsible for all operations from A to Z, right? So that means they're the ones on the ground looking for deals. They're the ones like analyzing and underwriting the deals. They put together the debt, they raise the money, they put together all the legal docs, then they actually close on the property, then they operate, execute the business plan, whether that involves construction, lease negotiations, whatever it may be. Then they're responsible for managing the asset post-stabilization. Finally, they're responsible for the final refinance or sale of the property. Now, the GP can usually consist of multiple people, right? It's not usually gonna be one person because this is a really complex operation, right? There's obviously a lot of floating parts, from everything from acquisition to raising the equity, to bringing on the debt, to managing the asset, to managing the renovations, to making sure all the investors in the deal are happy, right? There's obviously a lot of different components. So typically the GP will be a number of people or an organization, which can consist of a team of people, but there's usually multiple people that are actively responsible to manage and operate the transaction. Now, in terms of how the GP splits that GP portion, right? So let's say we have a 70% LP, 30% GP split. That 30% GP split will be split between the members accordingly to what they do and within regards to the property, right? So, as I said, there's all these different categories of things that need to be done. And typically they are split, the ownership split is based upon what everyone contributes and does in order to help the business plan move forward with the purchase, stabilization, and eventual refinance or sale of the property. Now, on the LP side, right, or the limited partner side, basically what the limited partners are responsible for is bringing the equity needed for the deal, right? So, you can imagine you buy a couple $1 million property, there's going to need to be a few $1,000,000 in equity provided to the deal, right? So basically there's going to be, either a handful or a lot of limited partners, depends on the deal. I've seen deals where there can be as small as 5 limited partners or as many as 100 or 200 limited partners, right? So it just depends on the deal. But basically all these limited partners are going to be responsible for bringing some portion of the equity required for the deal, right? And then their ownership in that limited partnership is going to be based on the percentage of what money they contribute towards the overall goal needed, right? So very simple numbers. I'll give you guys an example. Let's say there's a raise, there's a property we're going to buy and we need to raise $1 million. So, and a limited partner that provides $100,000 of equity is going to get 10% of the LP split, right? And again, if we have 70% if 70% of the LLC is owned by the limited partners, that means 10% of the 70% or 7% would go to that one individual who provided $100,000 in equity. So you're literally just getting your pro rata share based on how much money you put in of the limited partnership and ultimately the LLC. Now, a couple of key distinction points between the GP versus the LP. The GP is the one typically responsible for all operational decisions, right? So they're the ones that typically are going to have all the voting rights with regards as to execution, operations, and anything that needs to be done to the property. The LP, as it sounds by the nature of it, right, limited, is really not going to have any voting rights, and they shouldn't, right? They want to have limited liability into this operation, into the company, right? So all of the operations are really typically executed by the GP party. Now, in terms of how some of the other financial benefits or structures are done, we already talked about, right? The GP and the LP will each have their percent ownership in the LLC, which is fantastic. But one thing that's typically done to kind of really protect the LP's interest is something called a preferred return, right? And basically, that's the GP saying to the LP, hey, I know we're going to operate this building and I know we have a lot of incentives, but you guys are essentially going to take the first portions of the monthly cash flows so that you get some sort of return month to month on your invested capital, right? Because you're the ones that are actually investing the capital, whereas the GPs are essentially working on sweat equity, right? So preferred return is a percentage return on what the limited partners can get on their cash invested. So for example, let's say you invested $100,000 into a deal that had a 5% preferred return, right? Annualized preferred return. What that would mean is that every time there's any sort of cash flow distribution, right? Let's say the income is collected, expenses are paid out, there's X amount of dollars left over. The first $5,000, right? 5% of $100,000, the first $5,000 every year is going to be going to the LPs before the GP, the operator, touches that, right? So again, it's a good way of the GP telling to the LPs, hey guys, we want to make sure you get some sort of return before we dip into the monthly profits, which I think really aligns incentives very well. Now, in terms of how the GP gets paid, typically the GP will charge some sort of fees to the LLC when they close on the deal, typically called an acquisition fee. There's typically going to be what's called an asset management fee during the duration of the hold period, right? So basically that usually, those are going to be small fees that the GP collects, which essentially helps the GP run, his or her overhead, whether they have employees, technology, anything like that, that really helps run the operation smoothly. And I'll make a whole nother video about that. That's going to be the asset management fee. And then, of course, the GP is going to make most of their money on the back end when they sell. But what is critical to understand is typically, right, it's done in a promote structure, right, where the GP only gets paid when the LP receives all of their initial invested equity back, right? So the LPs have to get all of their equity back, right, all of their original invested capital before the GP essentially steps in and takes a percentage of their profits, right? So for example, let's go back to this deal you invested in. You invested $100,000 into it and the total amount of equity raised in the deal was $1 million. Let's say in 3 years, we go and sell the building. What will have to happen is the first $1 million, right, because we raised $1 million, is going to have to be returned to the limited partners from those proceeds. Then we actually have our true profit proceeds that are then going to be split according to the percent ownership owned by each party. So that's typically how it works. That's typically how GPs and LPs get paid. That's typically how the distributions are made. So whether you're an active investor looking to structure a deal or a passive investor looking to invest in a deal, hopefully that's helpful and gives you an idea of what to expect when investing in a multifamily syndication. If you guys have any questions, make sure you shoot them in the comments below.